Hello, my name is Brian Overby. I am the author of the Options Playbook, and welcome to Options Guy TV. Today, we have the big moment. The most magnificent of the magnificence is going to be announcing earnings after the close today. So, we definitely need to be looking at what's going on with NVDA. And the theme today is going to be about hedging the underlying stock. We may look at a speculative trade if we get a chance to do it. And I do want to talk a little bit about what's going on with the volatility in NVIDIA. It's a interesting skew as far as the volatility is concerned on the most near term and 1 week out expiration date. So before I get too far down the NVIDIA road, let's start by talking a little bit about what has happened on a couple of companies that announced earnings recently. Today, this morning, I should say. Actually, that's very recently. And it was in the retail space. And retailers are still announcing a lot of earnings, and they're just trickling on out. And it says a little bit about the consumer. But we did get some mixed metaphors like we have in a lot of these marketplaces. And the biggest one, and I think I'm going to pull up the chart on here. So let me show the chart right away. 1 second. And because this is a scary chart, but the stock Foot Locker, and if we go out, let's go out even further in time, where we're looking at a little bit more than a year, but let's go out 800 days. And we're dropping off precipitously, and you just almost worry about Foot Locker. So Nike is not doing well, and that has translated into Foot Locker, and Foot Locker is down $7.80 on the day. So a real strong move to the downside, and they cited a weaker customer. And they also came out and talked about their cash balance and talked about their ability, how much money that they have to be able to draw on if they need. So it's not a good story for Foot Locker, and it's a scary story to go along with that. And then if you to go in and look at another company that announced this morning, which was Dick's Sporting Goods. So let's go in and look at DKS, which is now down about 3% on the day. Once again, they cited a weaker customer. And also forecast came out that they see this going forward. Now, flip the script, and I do have to show you this chart because I was surprised on it. I knew that the stock had been doing well, but this really surprises me. And it's good old Abercrombie and Fitch. And they came out and announced that they had an awesome sales growth. And they actually said that they anticipate going forward that they will see more growth, and contradicting everything that we just heard about Foot Locker and Dick's Sporting Goods. So if we're going to go out, and I'm going to go out far in time here because I want to highlight. So let's go 1,200 days out. And look at this. We've got a brand new high on underlying stock. So that's actually a breakout. It's a gap breakout. We got all the ducks in a row on this. The only thing about Abercrombie and Fitch is that it's been perpendicular in the growth to the upside. So are you a little bit overextended? But if we came back and actually touched this all-time high in the underlying stock right around here, maybe you'd expect a bounce. Maybe you'd think about getting back in. So look at a little bit of chop, but just complete opposite. Because I guess Abercrombie and Fitch, I think of them as a similar type of client as far as age group is concerned. When you look at like Foot Locker and Dick's Sporting Goods, I'm really flabbergasted by the fact that they're having such a strong quarter. And they've forecasted such good growth going forward, where these two other stocks are hurting, and Foot Locker is really hurting at this point in time. So, all right. So that was the retail customer space. We have Jackson Hole, which is coming up here very, very shortly, August, right? 24th through the 26th. So they're going to start meeting out in Jackson Hole and having their big geek fest, I guess, with all of the Fed examiners talking about the economy. So usually we're going to get some comments, maybe some hints as to what might happen in September, even though the Fed, Mr. Powell doesn't like to try to give away any hints whenever he's talking publicly. And then obviously out in September, we have the next FOMC meeting, and that's the 19th. It starts on the 19th, and the 20th is the Wednesday, and that's usually when they give comments. So on Monday, we looked at a trade in the VIX. I'm going to adjust that trade. I'm going to look at that trade, and I'm going to move it out in time. I'll talk a little bit more about that because we got a lot to cover in today's show, especially regarding NVIDIA. So I'm sure if you're out there and you own some NVIDIA, you might want to participate in our conversation today. So please put any questions that you may have in the comment box, and let's start looking at NVIDIA. All right, so right now, NVIDIA, looking at the August 25th expiration here in the Trade Hawk options grid, it's saying the implied volatility is $161. The stock has made a good run up the last couple of days, and the chart has been ridiculous, right? They have been tagged with being the leader in the AI space and saying that basically every company needs their chips if they want to go forward with AI. It's a little bit of an over exaggeration, but the stock has taken off, and we're heading into earnings, and it's still going extremely strong into earnings. Market right now at 466.20. Looking at the most at the money option contracts for that August 25th expiration, which is we'll call it 466. We'll look at the 467s. If you do the math on that, we're talking about, well, and it's already moved on me. Let me look at my notes. 47 points is about the expected move, and it's even starting to increase from there. So if I look at buying the long call on the most at the money option contract and buying the long put on the most at the money option contract, we consider that the expected move. Now, that's over 2 days, right? That's because we're looking at an expiration that is on August 25th. So they're going to announce after today, you have all day Thursday and all day Friday for those option contracts to trade. But we're talking about an 11% move, either to the upside or the downside. That's the expected move. Now, remember, never has any regard to direction. And it's basically the line in the sand. Another way to say it is it's the over under as to the potential move that the marketplace thinks it could make. Now, I take the over. Mainly because the stock has moved almost that much in just the last 2 days leading into earnings, not to mention what it's done over the last few months. So I'm kind of surprised that it's actually at 11% range, and but the implied volatility is obviously through the roof, which affects the expected move, which is 161% is what the implied volatility is. So with all that said, I know a lot of people probably rode the NVIDIA ride. And if you did, that's wonderful. If you own some stock, it's very hard to not be nervous in this marketplace. And today I want to try to show off the TradeHawk software a little bit and look at what's going on with volatility. And the only time I've ever, well, not the only time, it's not even close, but one of the things that I saw when we were looking at meme stocks was a skewing in volatility where you really got some bullish trades that are coming in. Most of the time in a stock that's really made a big run up, or like, for example, if you look in the S&P 500 index and you look at implied volatilities on out of the money option contracts, you will usually see that puts will trade at higher implied volatilities than calls, and especially in the SPX options. And why is that? Well, out of the money option contracts are a lot of times bought for protection. It's the higher deductible insurance policy, if you understand anything about option pricing. And so there's usually a lot of demand for that as far as index options are concerned by larger traders. So you almost always see that the implied volatility on the out of the money options in the S&P 500 index on the put side trade at a higher implied volatility just because the demand is there. as opposed to the calls. Well, I'm looking at NVIDIA, and I was trying to figure out how to set up a hedge, how to protect your portfolio if you owned 100 shares of stock. What could we do to try to protect that? And if I look at the implied volatility, the stock right here, let's call it at 467, okay? Where the software, where the TradeHawk option grid is actually highlighting it. And if I go out of the money, I see the implied volatility is around 92, 93, 94. One standard deviation move out of the money, which is highlighted here by the shading on this option chain. So now if we go down and we look at and we go out of the money on the put side, look at what we see going on here. We're down in the 80s, 89. We go all the way down to the 400, just below the 400 strike, a one standard deviation move. And we're trading at 89% implied volatility. So there's a fun little tab up here on the TradeHawk software that we click on that shows us volatility. And if I look at this, we see that these puts, okay, so let me explain what this is showing instead of just jumping right into it. We have two different expirations. I'm going to use the September 1st expiration to put my hedge on pretending I have 100 shares of stock in NVIDIA. Right now, the most at the money, or the nearest term expiration is the 25th. And if you look from where the market is at on the way down, you see this is highlighting that vols here are actually lower than vols as we go up and out of the money here on the call side. So it's highlighting what we're showing, which I just showed you in real time on the chart, that you're actually paying up more for out of the money call options than you are for put options. So as far as the curve is concerned, that's showing a lot more volatility. And I'm just like kind of highlighting right in here, right in this range, more bullishness as far as people want call options and they're willing to pay up for them relative to the put options. And so I found that interesting, thought I would highlight that with you, but it also makes our trade a little bit easier to put on. So we're going to look at this expiration, which is the blue line, the 9/1 expiration. We still kind of see that little movement here compared to the out of the money. So we're going to do something that's called a collar, very simple trade. Some people might want to just sell option contracts, and I'm a little nervous to do this. I mean, I don't want to get pegged on my collar. If I owned 100 shares of it, I have a lot of, I would have a huge capital gain if I was doing this, obviously, in just an individual brokerage account, and a normal account, not an IRA account or whatever I may own NVIDIA in. But I am going to try to give you an alternative. If you owned 100, if you do currently have at least 100 shares of stock in NVIDIA in your account, going into this earnings, I still would be extremely nervous just because of the huge run up and the parabolic move that we've seen in NVIDIA. So I would look at going as far out as you feel comfortable. I'm going to spend a little bit of the paper profit that I might have on NVIDIA, but I don't want to pay full price for my put or for my protection. So we got the September 9th or September 1st expiration. Okay. 465, 466 is where the stock is at. If we go up about 47 points, which that's even moved a little bit, but on the upside, so if we go plus or minus 47 points, we're talking around 420 on the downside. We're talking around 515 on the upside. I'm doing a little bit of math to round them off to an even strike. So that's where we're talking about. If we just look at the expected move, what the marketplace thinks on using the August option contracts. Okay. So 11% move using those August option contracts. That's what we're considering. We're going to move out. We're going to go all the way up. Now we know that the one standard deviation move is always more than the expected move. If I sell that 515, I'm bringing in about $11. Now, if you want to, you can go further out and say, I want to go at least one standard deviation. If I go one standard deviation or more, I'm looking at 535, and I can sell that on the bid for 720. Now, that's how much capital I have to spend. Now let's go down and look at a put. So on the put side of things, if I want it to be a zero cost collar, well, I'm going to, first of all, let me just pick the call option. Okay. So I'm going to say that 515 is my call option that I'm selling, about the expected move out of the money. I'm going to use that as the example. $10.70, we'll call it right there. So I'm going to write that down, 1070. And I am going to click on that, and I'm going to add that to my to my call here. 1 second. 1015. Click on that. Okay. So that puts my sell in. Now I have that much to spend. Let's go down on the downside and say I can buy, if I want it to be a zero cost collar on my 100 shares, because remember, don't forget, I have 100 shares in my portfolio. I can go down to the 427.50 and I can pay for that. And we're almost even. We got 1060 by 1050. And if I click on that, 420 is where the expected move is at. And hence I'm highlighting here that you're getting more volatility on the call side than you are on the put side. That's simple. That's why I can go further out of the money on the call side relative to the put side and still be able to put off a zero cost collar. So I'll click on this one, but I'm going to remove it. Okay. So if I click on that, we got a buy, and this one needs to be a buy. 1 second. And now we're looking at about a 25-cent net debit. I'm giving up the upside in NVIDIA after earnings to protect my downside. And I'm paying 25 cents for that protection. I'm not having protection. It's not the crazy expensive insurance, right? Because we're going further out of the money. We have a larger deductible from 465 down to 427. So that's a fairly big deductible, but then my insurance policy kicks in from that point on. On a percentage move, that's not a huge move. It's less than the expected move, which is 11%, which would put it down right around 420, as I mentioned. So we're looking at just, I'm a little nervous. I'd like to stay in. I don't want to really lose the stock. A little bit worried about that gap to the upside. And this is the way that I could set this up and get a zero cost collar. Okay. Now I'm going to clear that out. And so if I do have 100 shares of stock, I'm a little nervous on the upside, especially what I'm seeing with a little bit on the volatility skew, big run up. And I really don't want to get pegged where it opens way more than an expected move. And I can't do much to adjust my position. So if I want to do it that way, I'm going to, if it was my stock, and because I don't mind paying and give it, especially because if you own NVIDIA and you've owned it for just even a tidbit, you got a big capital gain going on, right? So I'm going to sell the 535s. This is the one that I would sell. And this will be the official paper trade. And I'm going to pay something for my protection here. So I'm going to sell this for 715. And I'm going to go down and I'm going to kind of cut that in half. So I'm going to go to the 535s, and I'm going to buy that put. So in this instance, I'm going to have risk of 30 points on this underlying. So let's see exactly. So from 465 down to 435, that is 20 points. 465 minus 435 is 30 points. I said that right the first time. Divided by 465. So we're looking at a 6% move is when our insurance kicks in, right? The expected move is about 11%. So I'm going to protect myself from 435 on down. I'm going to have to pay for that. So just like in your car insurance, if your car crashes, they give you a new car, but guess what they don't do? They don't give your premium back, right? So you get the new car, but you still had to pay for the policy. And so they don't say, oh, you were right. You are a horrible driver. Here's your premium back because you crashed your car. No, but they'll give you a new car. But so that's the way the policy works. So that's a cost of doing business. So I still have to subtract that out from my 435 strike to get what my real, I guess, percentage loss would be if the market went down. Now, on the upside, I can go all the way up to that one standard deviation move at 535. So I got myself a lot of upside. So 465 minus 535, we're talking about 70 points of upside. So almost double. That worked out not bad. Paying $5.68 for that collar, don't mind paying that. If it allows me to stay in the stock and I don't panic and sell the stock because it's had such a big run up, I don't mind doing this. I don't mind this trade. I am still worried about a huge gap opening of maybe 120, 130 points because who knows what's going to happen. Nobody really it's hard to get your hand. I consider this when Tesla was struggling as a company, but was considered, the new company in the EV space, and can they really get their production line up and running and all this? Kind of a similar situation. Nobody really knew the potential with Tesla, and you can still make that argument that we really still don't know, right? But the stock has kind of came into favor a little bit easier to try to get your hands around it. Well, NVIDIA, we can't right now. Nobody knows what AI can do for it. So this could go either way, and I would like to be protected on it if I had 100 shares of stock. So if you have any questions, please feel free to put them in the comment section and I will address them during the show. Okay. That was a lot. And I don't think I'm going to do a speculative trade. If I did a speculative trade on this, I would definitely do like a butterfly. I would want something that I had limited and known risk on the trade. I don't want to be buying options outright. There's just too much premium in them. I could see a long call spread. That would be a potential trade, or go down if you're bearish, do a long put spread, but I'm going to be buying something and selling something. And I'll just leave it there because I'm going to run a little bit short on time because I want to talk about my Monday trade that we looked at. And I do want to adjust it. I mentioned on the show that I wasn't really sure when the Fed was meeting, which I don't know why I didn't write that down, but I didn't know that they're going to be meeting in September. So I'm going to adjust my trade because I tried to fill that trade on Monday and I didn't like the weekly option contracts. So we're going to do the monthly in the VIX. And I want it to be centered around that Fed meeting in September. So if I look at that expiration, we looked at the September 13th expiration. It's one of the weeklies. Markets weren't as tight. This is the monthly expiration. It's highlighted in green and it doesn't have a W next to it. And with VIX options, they stop trading on the day before the expiration. And it's mainly because you're talking about a volatility product, right? The settlement of that volatility product is all over the place because you got to wait for the SPX options to open up. You got to take the implied volatilities based off of the math that you're implying. And then you got to come up with a settlement price, which is the VRO. That's what the settlement price is for the VIX on that expiration date. Like I said, it's a very, very weird product. Okay. So with that VIX options, with that settlement date, the Fed is announcing on the 9th, or is going into their meeting on the 19th, and they're going to have their their press conference on the 20th. And so these option contracts will stop trading on the 19th, and the settlement would be determined on the 20th. I wouldn't plan on being in all the way up to that level, but who knows with the VIX? Who knows exactly what you're going to want to do with that trade? We were going to sell a put spread to be bullish on that underlying on the VIX and thinking about increased volatility as we go through the September months. And so with the market right now on the VIX is at 16.97. It's right around $17. Now, talked about it on the show, and we said that the VIX options follow the future. And so this, if this was true right around 17, the VIX call option wouldn't be trading for way more, well, 30 cents more than the put option. That means that this call option is a little bit in the money. And you can get a delayed quote on the future that's trading there, but we talked about the combination. So I'm going to do the real quick math to try to tell you exactly where this is at. So we'd take the ask price. We're going to go 1.67 minus that would be if we bought the long call minus the put price, and we'll call it 130. We'll give the midpoint 37. So it's 37 cents to buy a long call and sell a short put, going synthetically long the VIX index. If that were the case, you would have to pay a net debit of 37 cents. The call option is in the money, so you add that to the 17, and the actual futures contract for September is at 1737. It's higher than where it is right now. 1737 is about where that the underlying for this expiration would be trading. If you want to learn more, go back and look at Monday's show. I'm just going to leave it there. So I want to keep it about the same risk that we talked about on Monday. So I'm going to actually sell the 16 strike put, and I'm going to go 2 points down, and I'm going to buy the 14. And we're looking at 62 cents. On Monday's show, I think it was 68 cents net credit. We're going to do this for a net credit of 62 cents. We have a 2 point wide marketplace. So 2 minus 62 means we have $1.38 of risk, and we're going to let this trade ride. And this is going to be the paper trade because this is going to last for a while. I really want to ride this, and I love looking at VIX options and just talking about the VIX in general. So we'll come back and we'll revisit this trade. I just would much rather be in that September 20th expiration. So that's an official switching, a mulligan, if you will, on the VIX trade that we talked about on Monday. All right. I see we're coming close to time here. Do we have any questions on this? Nope. No questions so far. Okay. So very interesting day to see NVDA. We've been waiting. All of the FANG stocks, which used to be the name for the market leaders with net, but we had Netflix in the middle of that, have now changed to the Magnificents. And the most magnificent of the magnificent is announcing after earnings today, or after the close today. And it should be, I mean, grab your popcorn, right? I think it should be a fun thing to watch. Everybody's going to be talking about it. So we looked at a little bit of a hedge in that underlying, and I flip a coin. Who knows which way it's going to go? All right. So that's it for this episode of Options Guy TV. We'll be back 2 days. So we'll figure out what's going on with NVIDIA, and we'll be back on Friday at 11 a.m. Eastern time for the next edition of Options Guy TV. Please click subscribe. Please click subscribe and ring the bell and give us a thumbs up. It helps us out here. And we'll see you this Friday for the next edition of Options Guy TV. Thanks for coming, everyone.